Hi, welcome to Transforming Pemex, Restructuring Strategies for Economic Renewal and Mexico's Financial Prosperity. In the following slides, we will provide you the company information, the problem that it's facing, some solutions, the impact that it has to the economy of Mexico, alternatives, and conclusion. Let's start then. Pemex, or Petróleos Mexicanos, is Mexico's state-owned oil company primarily engaged in the exploration, production, refining, and distribution of petroleum products. Pemex was founded on June 7, 1938, when then-President Lázaro Cárdenas nationalized the country's oil industry, expropriating foreign oil companies. Pemex has historically held a monopoly on the exploration, production, refining, and sale of oil and gas in Mexico. However, energy reforms have opened the sector to private and foreign investment. Pemex peers in the region include Argentina, Brazil, and Colombia. Pemex has faced challenges such as declining production, aging infrastructure, and financial difficulties. In response, the Mexican government has implemented energy reforms to attract private investment and modernize the industry. Pemex has historically been a significant contributor to Mexican government's revenue. The company's financial health has been closely tied to the country's economic well-being.
Let's talk about the financial panorama of Pemex. If we see the total debt, the company still maintains a significant debt level of 2.1 trillion Mexican pesos. This high level of debt could pose a risk to the company's financial stability, especially if economic conditions worsen. Also, the total liabilities remain at a substantial 4.0 trillion pesos in 2022. This implies that the company is still burdened by a considerable amount of financial obligations, potentially limiting its financial flexibility. And finally, the persistently negative equity indicates that the company's liabilities outweigh its assets, raising concerns about its long-term viability. So, in conclusion, the company faces ongoing challenges with high debt, substantial liabilities, and persistently negative equity. This financial picture suggests a less than a favorable outlook, and the company may need to implement effective strategies to address its financial vulnerabilities and restore investor confidence.
So this is part of the Pemex financial information by segment. Industrial transformation is a segment that includes the debt refining division. Although only a single year is listed here, we have information that Pemex refining is experiencing ongoing financial losses for a long time. This is a snapshot comparing the performance of Pemex with company in the same industry and in other countries. What can we say from this? Pemex is facing challenges in profitability as well as financial stability due to its ongoing insolvency.
To understand why Pemex is heavily indebted and to explore potential solutions, we need to examine the company's structure. Currently operating as a government monopoly, theoretically, this structure should provide regulatory control in favor of public interest and stability. However, the reality for Pemex is quite the opposite. It exhibits all the drawbacks associated with government monopolies, including inefficiency, a lack of competition and innovation, abuses of power, and corruption. Given the critical role of oil and gas in Mexico, Pemex financial struggles influence not only the company itself, but also the whole state economy. The company's underperformance has led to downgrades in Mexico's credit ratings. Furthermore, the state's funding of Pemex comes at the expense of its citizens, and ignorance of climate commitments contributes to the negative international reputation of the country. Pemex is often treated as a so-called cash cow by the government, subjecting it to extreme high taxes. For example, in 2023, the taxes were 40%, and they are agreed to be 30% in 2024. While subsidies are created to lower gas prices and stimulate demand, The intentional blocking of private capital and competition hampers the industry's potential development. This tactic safeguards the government's control over Pemex, but stifles innovation and efficiency. The current state-owned monopoly model for Pemex is evidently inefficient and impacts the broader Mexican economy. Therefore, a comprehensive restructuring of Pemex is necessary. The question arises, what's the optimal form of restructuring for Pemex? After a thorough analysis of the company, we propose a solution to partially privatize Pemex. Specifically, we recommend privatizing the refining arm, which encompasses downstream operations. This sector is currently posing challenges for the company. In contrast, the upstream operations, covering exploration and production, exhibit profitability under the existing state ownership structure. Therefore, our suggestion is to retain state ownership over the upstream operations while divesting the refining arm to a private investor. This recommendation is grounded in several key factors. For example, the comparison of average rates of return. By upstream operations, it's usually 37%, while by downstream, it's only 8%. Our analysis highlights the exploration and production consistently generate economic rent. Conversely, the refining operations do not yield the same economic benefits, and the refining margins are higher than in other countries. Consequently, the proposed partial privatization aims to optimize the overall performance of Pemex by leveraging the strength of its profitable upstream activities, while introducing private sector efficiency and innovation to the refining sector.
If we talk about the impact of privatizing Premix refining, the benefit of adopting that solution will be capital influential and financial improvement, and it will focus on business operation with improving production efficiency, and it will help to enhance competitiveness through technological upgrade and profitability increase, and it will bring transparency.
So we assume the impact of not partially privatizing. First, financial deterioration and increased risks are assumed. Financial issues in Pemex's refining business could worsen, affecting creditworthiness and hindering future fundraising. Second, market share losses are more likely. Inefficiencies may lead to a competitive disadvantage, reducing market share and profitability. Third, employee uncertainty and trend drain will occur. Employee uncertainty and trend drain could weaken the workforce and innovation. Finally, it's about environmental and social impact. Ongoing inefficiencies have environmental and social impacts, making us a potential solution to improve operation and contributions.
The alternative solution of full privatization for Pemex involves several key
It's 10
aspects.
o'clock.
Pemex plays a significant role in the country's economy and energy landscape, but Pemex is viewed as more than just an economic entity. It's considered a symbol of Mexican sovereignty. This perspective suggests that the control and ownership of Pemex are seen as integral to the nation's identity and independence. The oil and gas industry in which Pemex operates is recognized as capital intensive. This means that substantial investments are required for exploration, extraction, and refining activities. The financial burden of sustaining Pemex in such an industry may be a factor in considering privatizations. This alternative solution involves considering full privatization, but is currently facing resistance from leading candidates in the presidential election. The focus is on modernization and, in some cases, supporting the use of renewable energy to address energy challenges.
So, another alternative solution is reconstruction from bankruptcy. Mexico has a legal framework for insolvency and restructuring. The process involves initiating rehabilitation proceedings followed by bankruptcy proceedings. The focus is on the crucial restructuring of financially distressed companies.
The Pemex board is made up of only men. Gender equality matters for business to succeed, but why? Inclusive teams with gender diversity enhance the quality of strategic decisions. Research indicates that inclusive teams make better business decisions up to 87% of the time. Also, gender diversity contributes to higher employee satisfaction and engagement. The gender diversity leads to lower turnover costs and lower turnover costs into economic savings for the company. And finally, gender diverse companies understand and cater to diverse consumer markets. Effective targeting of diverse markets leads to increased market share, and increased market share contributes directly to economic growth. So, despite the consideration mentioned, altering perspectives in Mexico poses a formidable challenge, primarily due to the prevalent male dominance in the country. This strange gender dynamic may influence decision making processes and societal attitudes, adding an additional layer of complexity to any proposed changes, including those related to the future of Pemex.
So if we talk about the final conclusion, Premix is a state-owned monopoly is an inefficient model for Premix. To reduce the Mexican economic and address Premix debt, restructuring is essential. And if we talk about how to restructure Premix, a partial privatization of Premix refining arm presents a strategical solution aimed at elevating the company's financial leverage, enhancing profitability, and improve operational efficiency. This initiative holds the potential to contribute positively to the Mexican economic.